So let me talk about market first. Okay. So if you guys can remember that we showcase that, that overall Indian outlook still remain very constructive. We have been very vocal about that. In January, we talked about a bit of risk of environment also, but we said that Indian macro on absolute and relative basis remains very good. Okay. So it's a buy on dip strategy, which we have been talking about from a longer term perspective. So let me reiterate few points today. Okay. If we try to understand, let's say what happened in last 1 month as compared to, obviously market has rallied a lot. Global market has less rallied. Indian market has done far superior. All concern which was there in the market of people not participating has been dilute up to a certain extent, and participation has increased. Now let's look at the larger macro numbers. Okay. So overall risk appetite, which started declining in the month of January onwards, still remains low, but marginally inched up. Okay, so it's marginally better as compared to last 3 months, but it is not as good that we can say that it's very aggressive outlook from the immediate basis. But if you recollect, right from September or rather October, November, we have been very vocal about how China data point was improving and good amount of money got shifted towards China. After 6 months or 7 months of good outperformance, also good amount of money flow was there towards Chinese equity. We have seen some amount of spike there, and we are seeing the early signs of reversal in some of the macro. Even the liquidity indicator has started dripping down a bit. Okay. So which means that Chinese market, some sort of pause we can talk about. And if I look at the liquidity perspective, then definitely it's a good news for India. If China started, we want to talk about if the China start getting more flows, which was the case for a longer period of time, I think that will now take a pause sort of thing. So it's a very good news from emerging market perspective, good news from even from India perspective. And so it's a constructive the background which we are looking at, that lot many FIs flow, if you notice, which actually shifted towards Chinese equity, is now coming back. Last 15-20 days of the FIs number is a clearly endorsement that money is actually shifting. So which is again a very good news from a medium term and longer term perspective. Also, there's some worry which we had about China market is settling down. People have, despite the data point was constructing, people have not able to make that sort of money in China, and the frustration for the global investor by investing in China in that phase has increased, and which is a good news for India. Now, if you really look at from the noise which is there in the, let's talk about a few minutes for the US market. The noise level in the US market relative to banking data, it is obviously a slightly disturbing news from a global perspective, because US being the mother of all exchanges, if something goes wrong out there, it has a huge psychological impact in all the markets. Okay? Now, if I just dissect the data in terms of minute details, then we can say that on relative basis, the US macro has deteriorated a bit. It has deteriorated even from the month of January, February, and March also. Month on month, marginal deterioration is there. Again, more on relative basis, less on absolute basis. Okay. Given the background we're talking about, yes, inflation has peaked out from a medium term and near term perspective. But in terms of some of the stuff which we look at from the risk appetite and liquidity is not in a great shape. Yes, liquidity has been improving. So maybe marginal dip last month, but ultimately direction is right. But if I have to combine multiple data points, still weak. Why I say weak about? Because in life, nothing is absolute. Okay? If returns are relative, we live actually in the relative world. Okay? So as a student of theory of relativity, we believe everything is relative. So we always try to see more on the relative basis, because ultimately money shift from one asset class to other, or one country or one region. So very important to understand the relative aspects. So on relative basis, US is not in a great shape. Given the background of the currencies, or the way dollar index has corrected and sudden the noise for de-dollarization has picked up a big way, overall outlook for emerging market has been more constructive. Okay? Which has been the case in last 1 month, 15 days in particular. If you look at US has not gone area, emerging market has been. India obviously has been one of the outlier in this thing. So net, if you look at the developed market underperformance, EM outperformance, and within that, India is emerging as a unique asset classes. Relative to China, we are in a better shape. So overall, very constructive for India. Okay. And if you really look at India also, the participation was quite low. If I have to just summarize the market from three players' perspective, retail, FIs, and the large HNI and family office, if you really analyze this data, you'll get a fairly good perspective. HNI, or let me start with the mutual fund and the retail flow. The retail flow remained equally strong. Okay, yes, you can say maybe sometime few weeks or few days it has been slowed down, but on a relative basis, the retail flows remain equally strong, which is a very good news for the market in general. And from a longer term perspective, that retail has emerged as an important segment in the market, which was not the case. It was predominantly institution driven market. So when I talk about retail, obviously it helps indirectly comes through mutual fund routes. So mutual fund has been strengthening for the retail flow has been very constant. Now look at the negative aspect or the flow which was negative from the FI's perspective for more than a year now, actually more than 15, 18 months, they were outperform. The outflows was there. In last 1 month, the flow has turned positive. And I can say with whatever data point which we look at that this sort of flow will has potential to maintain further and it has potential to go further. So good news is that FI which was sitting on the sideline or rather they were withdrawing money because India became relatively more expensive in last many quarters. So that was the case. Though that's a good news that has reversed. So which is a very constructive background. Now, third aspect is about the HNIs and family office. They were on sideline because they were more worried about global market, what is unfolding. The media noise was very negative. The narrative was equally negative. And I think a lot of people have missed out this rally. They were not willing to participate. And I have seen a phenomena. The so-called family office is also was very much worried. Okay, they have accepted the fear which was sold by most of the people on the market because it was easy to sell. Okay. And I always say, look at data versus narrative. Narrative is something what people sell. Narrative is something which get built, and data is very different. We try to analyze and say what is the true picture. So they have missed out. Good amount of chasing can happen now because people are sitting on sideline. They are getting panicky now. They have missed out. So, and that's the reason you have seen a very recent up move despite BJP lost Karnataka election. Look at the moves. Everybody thought it will open weak and some sort of selling pressure can emerge. But reverse has happened. We came closer to 18,000, what 500 mark now. So it's a good move which we are saying. So again, from purely from the flow perspective, even that participation is started. Now let's come to the larger thesis which we always talked about. Okay. Okay. So if you recollect, I always talked about that at quant, what we try to look at, we are a believer of adaptive asset allocation thesis. Okay. And we try to understand what type of environment which is prevailing. It really helps us in taking a call. We have been very vocal and have been showcasing that between 2018 until 2023, it will be the volatility expansion phase, which means the employed walls of the most of the global asset classes will remain elevated from a longer term perspective. So, and if you recollect nearly 5 years, that cycle which we talked about played out beautifully. 2018 volatility spiked. 2019, the employed was drifted a bit lower than 2018. 2020, we all know what happened. This meltdown happened for a few months' time. So we talked about volatility expansion. 2021 slightly lower than 2020. 2020 it expanded further, and even beginning 2023, the equity employed walls has yes definitely corrected, and this is one worry which we have, which I'm going to talk about. Okay. So in 2023 is actually the culmination phase of the volatility expansion phase we talked about. What it means? It means the volatility expansion cycle, which talked about compressions or expansion, which happens globally, that cycle peaks out. And if the cycle peaks out, typically cycle peaks out with extra amount of spike. It never peaks down and volatility is settled down and just collapses. It never happens. So typically at the last leg of the cycle, you will see a massive spike in volatility. And the way employed walls of the equity market or some of the asset class of late has reduced, okay, It's an indication sometime in technical terms on the derivative market, people call it sticky balls. Okay. So we believe there could be a possibility of that spike is not ruled out. Okay. But my worry is not equity market. So let me give you our concern where we are worried. Okay. Our larger view is that if we have to believe that volatility expansion will play out in 2020, and we have talked about in January presentation, we expect that first half will be more challenging and second half will be better. And within that second half, the fourth quarter of 2023 or beginning of first half of 2024, we have said that you will see all-time high. And when I say all-time high, not means that 100 points higher than the all-time high, that does not make sense. Something meaningful and decisively. Today, we are just what 1.5% or 1.5% or 2% away from the all-time high, whether you talk about NSE 500 or Nifty. Bank Nifty is very close, and so is, and some of the indices are already at a lifetime high, including the PSUs, PSE index, or you know, about the capital goods or even FMCG index. So when we talked about these data points, whole idea is to just give you perspective in terms of clarity. Okay? It should not happen that people actually get panic at the time of buying opportunity. When the best buying opportunity comes, people just give up. If you are mentally prepared, what can come, and that's the whole idea, and that's the way we operate. We have been very clear. This is already expansion phase, and one of the reason I talked about in this phase, your buy and hold strategy will not be very effective. Okay? So that's the way, one of the reason why in 2018, when we took over as Scots, we talked about the dynamic style of money management. We could be the only mutual fund in India which was actually doing the concept or practice dynamic style of money management. Globally, it's picking up, particularly in the US market. So because we all live in a very dynamic world, data keeps on changing. Our money management style cannot be very static. Okay. So something has to be changed. With this background, so let me explain you where we think volatility can expand. There is no problem on the Indian macro. There's no issues in the Indian currencies also. Our worry is if volatility expansion phase will happen, I think the first signs which is coming, it will either come in the form of geopolitical event where the energy prices can spike, whether talking about crude or natural gas. And something similar characteristic is visible even on the currency volatility front. Whether you talked about JPY, whether you talk about Swiss franc, or maybe some spike can unfold in the dollar index also, which has been correcting for a while. It has become a consensus trade. So our worry is that somewhere in the currency market and the energy market, there could be a probability of volatility expansion, which can play out. Uh, since we all live in a world which is dynamic, so it's all about a game of probabilities. Probability is high. Okay? But if any such events unfolds globally, okay, and I have been very vocal about it in every presentation, every forum I have been talking about, if that opportunity unfolds, for whatever reason, something I will not use the word ugly or something unwarranted plays out, whether because of the currency movement or because of geopolitical, which can lead to a movement in the energy prices, then one should be very, very clear that could be the greatest buying opportunity. What happened in March 2020 when COVID happened? Market just corrected sharply, and it was one of the biggest opportunity. We are not talking about that sort of correction also. I said if, the big word is if, and when we look at data points, if any data point showcase, we definitely keep in mind. And that's the reason I'm being very vocal and talking about if that opportunity is out, nobody can say with certainty whether it happens. As of now, our predictive analytic thesis is showcasing the signs of volatility expansion has to happen in 2023. And if it happened, that could be the biggest buying opportunity for India. And Indian investors should not lose this opportunity. FIs are eyeing that opportunity. They have been seller in the market, and there is some amount of, I'll use the word desperation to come back. Okay. And what is very important to understand, because it is a big risk off environment, Indian liquidity also decline a bit. The impact cost in Indian market has gone up significantly. So in the month of, when we talked about in the month of January, February or March, when the correction happens, because of impact cost, the price damage was relatively on higher side. Similarly, when up move starts and there's a desperation to chase this up move, the impact cost will be also play a role, and hence with low volumes market can spike, and which is the case what you see what is happening. Now, if you as an institution, whenever we try to participate, something very sizable quantity stocks are not up. Okay. So very clear, if anything, something like this unfolds, it should be one of the greatest buying opportunity, because every forum I talked about, after 2023, things will stabilize globally, and India is the biggest beneficiary. So we remain constructive both from a medium-term perspective, long-term perspective. Also, we said this decade belongs to India. In fact, lot many channels I talked about, the half century belongs to India. So that is the bullishness you can understand. This is not a marketing pitch in any manner. Okay, this is the perspective, because we as a house, we say it's a data-driven company. We are slave of data. Objectivity is our religion, and data is God. So everything revolves around data. And this is something which we talked about. And if any opportunity emerges, one should be aggressive buyer. So, but we just want to sound it to you, is so that you should not come and surprise and say, oh, this played out, we were not prepared. We are completely mentally prepared. If any opportunity comes, we'll be aggressive buyer in that phase. And I expect by end of September 2024, between July to 2000 or September 2023 itself, we believe that even the risk of environment could peak out. Okay? Because liquidity is anyways in our favor. Globally, liquidity cycle has bottomed out, or the tightening cycle has peaked out. So I always talked about that liquidity cycle plays with a lag effect in typically 2 or 3 quarter cycles. So somewhere between July to September, that cycle should also play out in our favor. So one of the reason we believe that maybe from fourth quarter, third quarter of 2023 should be the great buying opportunity, and will be much more broad-based rally. One of the reason you have seen quant mutual fund is launching a lot many funds, because we want to optimize that opportunity. One aspect is very clear, a lot of demand is coming from, we now started servicing the family offices also, wealth outfits also. A lot of demand for this type of products coming, and we are very clear, we are very opportunist as a house. When we see opportunity, we will be launching many thematic fund in future. When technology sector, we looking at technology also, could be having very negative in the technology. When it bottoms out, we will be looking to a lot of things. So it's a strategy behind that, because we believe this is a great opportunity for next many years perspective, and hence we want to expand our bouquet also. And this is a time where September 2024 to 23 onward, we said could be a risk on environment, and thematic funds will also be extraordinary. So timing is very vital in from a thematic point of view, because these are more concentrated funds. Okay. So I'll stop here. I will take some of the questions also. So let me come back to the presentation part, or on the NFO which we talked about. Okay. So we today going to talk about business cycle fund. And if you recollect last month call, okay, our monthly call, I explained the concept of money flow analytics, how money shifts from one asset class to other, how money shifts from one sector to other, and how money shifts from one stocks to. Okay? And we have explained the logic behind that, how mathematically it works. Okay? And whole idea was of that thesis was to prepare you. This is the way it works. So we also want to educate lot many people the dynamic style of money management, the new tools which we bring, how mathematically we decode this thing. Something we don't work on the gut feeling. You know, this is my view, this is my experience. We don't come with that big ego of mine. Okay, this comes on the background. It's about data-driven organization. It's all about mathematically how well you can decode this thing, how well you can quantify. And some of the case I will showcase. These are the real examples which we have played out. So let me give you a small background, the business cycle funds. Okay. Now, we all know every individual goes through a cycle. Every business house goes through a cycle. That you talk about the infancy stages. On a lighter note, people have your own horoscope, and people say my cycles are bad. We talked about Sadhasati, we talk about a lot of other things also. So it's a phenomena where at least Indian understand the cycle phenomena, because everybody goes through certain phases. Okay. And we are very great believer of cycles theory. We believe there's a science behind that. We understand the mathematics of these cycles. And it's all about how well you decode some of this. If you recollect some of the presentation, I showcased that when in 2012, I talked about the 2020 and 2030 will be very challenging and bubble will burst in. We talked about cyber war, we talked about biology or deteriorating weather condition, we talked about extraordinary inflation, we talked about highest ever interest rates. But we didn't talk about gold prices. 10 years back, something which we written played out year by year also. How is possible? Okay. This is the strength of cycle phenomena. Okay. When multiple cycles coincides, okay, it creates that momentum in terms of, if I have to say, mathematical terms, that spikes happen, the amplitude spikes. So that could be the way we try to capture the probabilities. When multiple cycles coincide, the probability of that event increases. This whole business is about all probability. Okay, when you have more winning trade versus losing trade, the probability of you generating more alpha is on higher side. So this entire thing is about decoding the probability of that event. When we said few minutes back that we expect spike in the currency war, we expect the energy prices rallying. Okay, it's not a, what do you call it, gut feeling basis. We are telling you this is what data points are showcasing. Okay, one way of looking data that you get scared when it happens, but other opportunities that if you understand what is coming or what is expected, that's the strength of predictive analytics. Okay, that we try to foresee what is coming with the help of with the help of data rather than looking at the narratives. Okay, so the moment you start differentiating between narrative and data, then you have more clarity and more answers for it. So that's the way the genesis of cycles funds come into picture. Okay, so we are talking about when we're talking about cycles fund, obviously clearly looking at is a thematic funds, and hence perceived risk is on a higher side. But I always talk about if cycle is in your favor and if you can time the cycle, again, timing, risk management, not trading from any perspective. If you can time the market or time the cycle, you have a probability of losing less your capital virtually at the bottom of the cycle. If you are trying to enter into sector or stocks, probability of you making losses is on the lower side. Or the frustration or the value trap, sometimes we talk about that you are relatively early, 6 months back, 8 months back. I'll explain you with a classic example how ITC unfolded. It was a very classic value trap people were getting trapped for, but we bought virtually at the bottom of the cycle. So we didn't have to bottom of the cycle, both in terms of prices as well as timeline also. Immediately when a quarter started rallying. So when we talk about business cycle fund, the cycle fund is a very clear indication of conviction because you're talking about thematic, you're talking about limited sector, and we're talking about taking a very concentrated bets. Okay, that's the way you can conquer this whole thesis of cycles fund. Okay. So if I have to call it a cycles fund, we are talking about definitely a concentrated play. Okay, that's the way the risk of thematic comes into picture. But if you can time it better, then it works in your favor. So now let's talk about how exactly it plays out. Okay, as I always say, quant is a very macro house. Okay, we look at macro data very closely. Life starts looking at from the currencies record, credit market data, look at the commodities market, fixed income, and last market. And when you look at the larger macro set, okay, and we try to demystify that, then you get answers. So there are certain sectors which could be beneficiary of that, and there could be certain sectors could be partially affected or affected badly. Okay? And that's the reason the entire thesis revolves about a macroeconomic cycle. With the help of macroeconomic cycle, you get multiple. That's the reason you see the wheel as of the cycle we have shown slightly bigger. Okay, which means a macroeconomic opportunity leads to identifying certain sectors. And if you can play out these cycles in your favor, okay, then the whole thesis will work beautifully. So this is one of the picture which we generally have showcased in our book also. It's there, part of our website also. What type of cycles analysis when you talk about? So when you're talking about that, ultimately we are all, as a human being, we are all governed by cycles. Okay? And this is phenomena, something which we have to talk about, which we want to discuss. Okay, Let's talk about few cycles just to give you some perspective. When we talk about large civilization cycle, when we talk about large, uh, we heard a lot of concept like a super commodity cycle or war cycles or interest rate cycle. Okay, and this we can keep on drilling down and down, and we can see what is coming. So some of the cycles have very 100 years, 2 years, 1,000 years. Okay, point. When we talked about agriculture bull run in 2012, I talked about the 2020 onwards in 2030, the biggest bull run in our life. You will see agri, and agri prices will go to the roof. How we are able to predict? Because we have data of agri, we have a data of wheat, more than 1,000 years data. When we will connect the dots with the climate cycles, when you connect the dot with the inflation cycle, when you connect the dots with earth analytics, what is changing, how magnetic fields are changing, how the earth data points, how the sunspot cycle is changing, how the magnetic fields are changing. When you try to combine a larger perspective, you get answers. And this is what we are trying to showcase, how the cycles are interlinked. The beauty of this whole cycles analytics thesis, which we work, is try to understand the lead and lag effect. Okay. Lot of people educate us. This is the correlation. This is the way it works. Okay. Partially they are right, and most of the time they are wrong. Okay. Because where the problem starts, if certain data points can be a leading indicator in certain phase of environment, sometimes they can be lagged with different data set. So something similar characteristic can be a leading indicator, and something in a different environment, the same characteristic which you talk about can be a lagging indicator. So it's very important to understand. If I have to say, connect the dot and say mathematically, when you talk about history, repeat history, is not, it's rhymes actually. But if you have to say mathematically, when you both independent variables are something similar, what happened 20 years back, 10-year cycle, 20-year cycle, 100-year cycles, if it is exactly similar, the probability of that repeating is on a higher side. But this is we don't live in a very idealistic world, or this is the way it will happen. Okay, so we try to understand the skewness of that, we try to understand the probability of that. Okay, and it's not very easy. When we try to connect the dots, we get answers. This could be the phenomena. So I'm just for the explanation sake, I'm just trying to explain you how it works. Okay, now let me explain you more from a mathematical aspect. We talked about how the art and science of cycle analysis work. I'm not getting into what we have written. You can read that when you have the presentation. Whole idea is to just explain you how deep these relationship are, and the ability to connect these cycles, that is our biggest edge. And that's the reason something which we wrote in 2012, how year wise year this will play out, beautifully played out. So that's the way the data points helps you in seeing what is coming. Let's take some example. Okay, so before we talk about, so we talked about, if you recollect last call, we talked about money flow analytics. Okay, it's a behavior indicator, and this is one of the reason how we able to identify stocks and sectors in particularly, because it really helps. So when we talk about this, a combination of both risk appetite and liquidity or fluidity of the market, stocks, or even sectors. Okay, when we talk about how environment is changing, how risk appetite is changing, how the liquidity is changing, how the fluidity of stock is changing, when you try to combine these data points, you get answers. So let me explain you, instead of talking about theoretical stuff, let me explain you some live example. And this is example where I want to talk about, this is something which actually we have implemented and practiced. Okay, so if you guys are familiar, September 2021, okay, when we spotted there's a euphoria in global equities, and we dissected the euphoria. Why there's a euphoria? When you dissect the euphoria and the value versus growth, we realized the euphoria was in growth stock. The euphoria was a new age company. Euphoria was a technology sector. There was no euphoria in value stocks. That's the reason in last 1.5 years, value outperformed. Okay, off late, mine underperformance, but that's the problem. Let's understand, when we spotted IT, the first thesis came that there was extreme euphoria. If I get into if we create a synthetic index of, let's say, IT companies in India or globally, what was the risk appetite for the synthetic index? It was on the highest in September, October 2021. Liquidity was on the highest. That's a very classic long-term valuation talk. Okay. Not a single analyst in this country or any reputed global house has a sell report on technology stocks. We sold all the technology stocks in our portfolio September, October onwards. 8 months later, by June, July, or May onwards, people realize, oh, the stock corrected 30-50%, and then they say, oh, that was the top. So again, the importance of timing, very, very vital as a risk mitigation tool. How we spotted that move. Now let's talk about banks. Okay. If some of you track our portfolio, right from September 2019 on, or let's say talking about January 2020, when we talked about this is a difficult phase and bubble can burst. Between January to March 2020, we were actually seller of technology names, of the banking names, all the leverage economy names we picked out. So we sold all the bank. If I'm not wrong, by April numbers or April 1, 2020, we didn't have banking in our portfolio. So nearly for 1 year, we didn't have banking in our portfolio, despite the weightage of 40-45% the portfolio. Yes, we had some of the insurance companies or the mutual fund or the wealth company. So first quarter of 2020, what we spotted, risk appetite highest, liquidity highest for this sector, a long-term valuation top. And we all know how badly banking perform in that phase. Let's come back, same year, September, October, if I'm not wrong, it was September 2020. Instead of writing month, we have just deliberately put quarterly, so it becomes easy to explain rather than getting on particular day or particular thing. But it was the month of September 2020 when we saw, after a massive correction, the risk appetite collapsed significantly and liquidity was early stages of rising. So we talked about a medium-term valuation bottom, which happened, and we saw a rally. Something similar, if I have to explain you from and something similar happened in September 2021 also, where we talked about when IT, it was not as classy as September 2020 in banks, but it was a phase where IT sector peaked out, banking bottomed out, and this was area we looked into it. Now, let me give you some very live example, a very interesting case of pharma. So if you recollect, all pharma stocks peaked out between March to September 2015. Okay, most depending on stocks to stock, that was the, and it was one of the long-term tops. Okay, now let's understand mathematically how we decode. So we talked about in fourth quarter of 2015, we saw the risk appetite for that synthetic index was one of the lifetime highs in that basket of the stocks. Talk about liquidity lifetime high. This was a long-term valuation top for the pharma sector in general. And come back 4 years later, okay, in September 2020, 2019, we spotted that risk appetite collapsed significantly, one of the lowest point. The liquidity was slightly inching up. That's one of the reasons we talked about long-term valuation. And since September 2019 in our portfolio, we have many pharma names, specialty chemicals name, and even agri-chemicals name, or hospitality space. So area which we spotted, and one of the reasons why we got massive outperformance in 2020 was special credit should be given. A, we didn't have banking names in our portfolio, and B, we were skewed our portfolio towards pharma. That is one of the reasons we outperformed significantly. Now come to September 2000 or October 2020. That's a time again we saw one of the high risk appetite. Liquidity was high, risk appetite is high. That was the reason a medium-term top. We were very early in exiting pharma stocks. We made phenomenal money between September 2019 till September 2020. We exited pharma from its levels. Now, if you have noticed, if you track our portfolio, in fourth quarter of 2020 also, now coming to 2023, the first quarter, okay, between February, March, we spotted that risk appetite for this sector has come down significantly and liquidity is marginally creating. So again, we took a conscious call and say some medium-term bottom for the sector, pharma sector, and beautifully it picked out. You see some of the stocks have given significantly move in this opportunity, in this phase. Now I'll give you two small examples. The same thesis applied if we have data points and if we can mathematically decode, we can talk about even the stocks specific. So ITC, September 2021, okay? Risk appetite very low, a very early stages in terms of valuation, in terms of liquidity. That was a very classic sign of valuation. If I add lot many more data on behavior like quant fear index, lifetime high. Okay, the quant greed index of ITC was lifetime high in 2013, if I'm not mistaken, and the fear index is lifetime low. So it's a classic case where it's like go all out sort of strategy, then you invest completely in that space. One of the reason a large holding we have ITC in our portfolio across all the schemes, okay, including small cap, we have very large, and it turned out to be a winner. It actually generated. We bought as a special situation, but turned out to created a massive alpha for us. Look at another example, ICICI Bank. And this is just, we don't talk about stock, but I'm just trying to explain you so you understand how exactly mathematically it can be decoded. ICICI Bank, fourth quarter of 2022, September, if I'm not wrong, we exited ICICI Bank. Why? Risk appetite was highest, liquidity was higher. It was not the top of the stock. We are neither saying it is the top of the prices, nor we are saying the top of the earnings. What we're talking in the current quarter, last quarter earning was phenomenal. And but stock, if you notice, underperformed. Okay, so it's talked about a long-term top happen in terms of overall perspective in September 2000. We shift from ICICI Bank to HDFC Bank. We generated more alpha. Just to give you some example, uh, see how exactly and beautiful it works. Okay, now I want to let's talk about one of the final slide for the this business cycle fund. What is fund positioning? Very, very clearly is a thematic fund looking for longer term investors. So that because cycles can be played out from a longer term perspective, we are not talking about a near term and short term cycles. Here we're talking about extreme climatic phases or the extreme inflection phases where I've shown the example when the sectors peaks out or sectors bottoms out. Those are the times like how pharma took 4 years. IT was bank was only 1 year it changed. So it's not like that saying that every 1 year it happens. Okay. Neither we want to predict those things. What is very important as data change as it unfolds, when we see those extreme levels of panic, extreme levels of greed, and when the sector hits the most admired territory or sector reaches the most neglected zone, the extreme levels, those are the moments we want to use for sector rotations. Okay? And if you get that thing right, the probability of generating alpha will be high because this is a fund which we are looking at more concentrated bet. So I'm going to talk about. So this is again a suitable for a very long-term investor. We are not recommending for anybody who's coming for a short-term 1 year, 2 years period, 6 months period. This product is definitely not for them. This product is for the 5 years, 10 years horizon people. The advantage is that the cycle fund is not one sector. We have a flexibility to play around with multiple sectors. Okay. So very clearly explain you how the predictive analytics model, how the money flow analytics works in this thing. Okay. What we are trying to showcase that we are looking at 6 to 8 sectors. And within that also, we are looking at concentrated 3 to 4 sectors. Yes, we will do diversification via stocks, but the sector will be concentrated. It effectively is a very concentrated portfolio which we want to run. And that's a risk one should understand from a thematic point of view. But I always said that in the thematic fund, if your timing is right, you will be winner in long run. Okay. And you will be winner with a sizable margin because if you have patience to identify these inflection points and remain invested, that's a way. So this is, we are not calling this product another fund from our side, which is well diversified or nothing. This is a very, very concentrated portfolio, which we are trying to talk about. So it's a very unique way we are trying to position this product. Most of the people run this product, another flexi products out of. That's not the way we are running it. We are very clearly saying a concentrated bets. Okay. Now talking about in from a risk perspective, again, we are saying that any sector will not more than 33%. So it's merely from a risk management perspective. Generally, we don't go actually more than 20% also. But since this portfolio will be relatively more concentrated and if the opportunity is right, we have that flexibility or luxury to take concentrated bets. Okay. So this is the whole thesis which we talked about in terms of the strategy behind that. Last slide, I want to talk about disruption. Okay. So a lot of people say you are disruptor or this is a disruption thing is happening. I call it innovation. Okay. Disruption or innovation, whatever way you want to understand, gives you unique opportunity. And as we are seeing that in the way technology is changing last many months or many quarters in last few, particularly last 1 decade, the way changes are happening. These disruption or innovation gives you phenomenal opportunity from a sector rotation. One of the reason is not that earning is impacted on immediate basis. Okay, any stock or sector moves up both with the herd of earning expansion and the multiple expansion. The P deterioration happens very fast, or P expansion also very fast. Okay, that's the way we have seen the bull run in some of the what do you call it, new age companies. It's all about the P expansion, earning expansion yet to come. It was all the P expansion which played out, and reverse is also true when the any admire category stocks disappoints, the P deteriorations are equally sharp. And if it is driven by ESG phenomena or it is driven by any event or any disruption, the the falls are very, very sharp. Okay. So again, it helps in from the sector rotation perspective. So this is the broader thesis which we are looking at, our thesis on the market. Okay. So all other theses remain how we identify the stocks and thing. You guys are all familiar with that. The issue is just open on 12th. It is closing on 15th this thing. So, and the last slide, look at the one of performance which we have built over a period of time. Okay. And what is very important for us to understand, in a risk off environment, our strategy is very different. I said in January 2000, it's a risk off. In risk off, your safety is first priority, liquidity is second priority, and the returns of okay. The moment it changes, that's why I'm saying that somewhere between July to September or maybe September month, I personally expect that's the way data points are showcasing. It reverses, then it will come with a vengeance. That if that risk off environment, risk on environment comes, we will play very aggressively. Okay. So sometime not necessary that you have to, because I have seen industry works on same portfolio structures. Their portfolio remains, the strategy remains the same throughout the year, or for years remain the same. That's not the way we operate. Our portfolio is very different in risk on environment. Your portfolio is very different in risk off. Since we believe that it's a dynamic style of money management, so we rebalance our portfolio